In 2014, Tony Robbins spent 4 years interviewing 50 of the world's most brilliant financial minds. Warren Buffett, Ray Dalio, Carl Icahn, Jack Bogle, David Swensen, Paul Tudor Jones. The people managing trillions of dollars collectively. The people whose decisions move markets. He asked them all one question. What would you do if you were starting over with nothing? The answers, across 50 of the most successful investors in history, produced a 688-page book called Money Master the Game: 7 Simple Steps to Financial Freedom. And here's the single most important thing Robbins found across every single interview. These 50 billionaires and investment legends, despite completely different strategies, completely different personalities, completely different markets, shared 4 universal principles. Number 1, don't lose money. Number 2, risk a little to make a lot. Number 3, anticipate and diversify. Number 4, you're never done. That's it. 4 principles across 50 of the most sophisticated investors alive. The common denominator of extraordinary financial success is simpler than almost anyone believes. This video breaks down all 7 steps from the book and translates every single one into the specific Canadian tools, accounts, and strategies available to you right now. Because Robbins wrote this book for Americans, but the principles are universal, and Canada's TFSA, RRSP, and FHSA make some of these steps even more powerful than the American versions. Let's get into it. Robbins opens the entire book with what he calls the single most important financial decision you will ever make. Not which stock to buy, not which house to purchase, not which job to take, how much of your income to save and invest, automatically, before you spend a single dollar. Robbins calls this paying yourself first, and he frames it as a non-negotiable automated decision, not a monthly discipline test. The savings rate is not what's left over. It's the first allocation. Everything else adjusts around it. He uses a powerful reframe. You are not saving money. You are building your freedom fund, a money machine that will eventually generate enough income to replace your employment income entirely. The specific goal Robbins sets is to determine your critical mass, the portfolio size at which your investment returns exceed your living expenses. At that point, you are financially free. Your money machine produces more than you need. Work becomes optional. The Canadian application. For a Canadian earning the median household income of $93,000, spending approximately $55,000 per year, financial freedom requires a portfolio generating $55,000 annually in passive income. At a conservative 4.5% dividend yield, that requires approximately $1.22 million invested. At 8% annual return, with $1,163 per month invested, 15% of $93,000 gross, that portfolio is reached in approximately 27 years. At 20% savings, $1,550 per month, in approximately 22 years. The Freedom Fund concept is not abstract. It is a specific number, your critical mass, and a specific timeline determined entirely by your savings rate. Robbins's most important message is, decide the percentage now. Automate it today. Never touch it. The specific Canadian vehicle. TFSA first. Every dollar of Freedom Fund growth inside a TFSA is completely tax-free, making the Canadian version of Robbins' money machine more powerful than the American equivalent. A $1.22 million TFSA generates $54,900 per year at 4.5% yield. CRA takes nothing. It is the perfect vehicle for the Freedom Fund. Your action step: calculate your critical mass right now. Annual living expenses divided by 0.045 equals the portfolio you need for financial freedom. Then calculate how long it takes at your current savings rate. That timeline is the most important number in your financial life. Step 2 is the most eye-opening section of the entire book. Robbins calls it Becoming the Insider, and it's essentially a chapter dedicated to exposing the financial industry myths that cost ordinary investors a fortune while enriching the institutions they trust. Robbins identifies 9 specific myths. Here are the 5 that hit hardest, and that every Canadian investor needs to understand. Myth 1. Mutual funds beat the market. Over a 30-year period, more than 96% of actively managed mutual funds fail to outperform a simple index fund. Robbins quotes Jack Bogle, the founder of Vanguard, directly, "The only reliable way to capture market returns is to own the entire market at the lowest possible cost." The Canadian application: the average bank mutual fund charges 2% to 2.5% MER annually on a $300,000 portfolio over 30 years. That fee drag costs approximately $1.29 million in lost wealth compared to a 0.20% MER index ETF, like XEQT. The institution takes the million. You get what's left. Myth 2. I'm in a 401k, so I'm okay. For Canadians, substitute RRSP or group pension. Robbins' point is that the vehicle alone doesn't protect you. What you hold inside the vehicle, and what fees you pay, determines everything. A Canadian RRSP filled with 2.5% MER bank mutual funds is not a wealth-building tool. It's a fee extraction mechanism. Myth 3. Financial advisors have a legal duty to act in your best interest. In Canada, the best interest standard applies to registered investment advisors and portfolio managers. But many financial salespeople operate under a lower suitability standard, meaning they only need to recommend products that are suitable, not optimal. A product can be suitable and significantly more expensive than a better alternative. Knowing the difference between a fiduciary advisor and a commission-based salesperson is one of the most valuable pieces of financial knowledge you can have. Myth 4. Our fees are only 1%. That's tiny. A 1% annual fee sounds insignificant. On $100,000 over 30 years at 7% return, the difference between paying 0% and 1% in fees is approximately $182,000 in lost wealth. Robbins' most impactful line on this: a 1% fee can cost you as much as 29% of your total future nest egg. Myth 5. You need to take big risks to get big returns. The most sophisticated investors in the world, Ray Dalio, Paul Tudor Jones, John Templeton, obsess over asymmetric risk. They structure bets where the downside is small and the upside is large. The goal is not to take more risk. It is to find opportunities where the risk-reward ratio is significantly tilted in your favor. Your action step: ask your financial advisor or bank 3 questions. Are you a fiduciary? What is the MER of every fund you've recommended to me? And what would the total fee drag be on my portfolio over 30 years? The answers to those 3 questions tell you everything about whether they are working for you or for themselves. Steps 3 and 4 are where the book moves from philosophy to framework, and Robbins introduces one of the most practical mental models in personal finance: the 3-bucket system. Robbins divides your entire financial life into 3 buckets. Every dollar you save goes into one of them. Together, they create a portfolio that can handle any economic environment. Bucket 1: The security bucket. Everything in bucket 1 is safe, protected, guaranteed, or near guaranteed. The goal of this bucket is not to generate maximum returns. It is to never lose the money. Contents: cash, emergency fund, money market accounts, bonds, GICs, fixed income, whole life insurance, annuities. In Canadian terms, your emergency fund at EQ Bank earning 3.5% to 4.5%. Your GICs, your government bonds, any fixed income ETF in your RRSP. This bucket is your sleep at night money. Bucket 2, the risk/growth bucket. Bucket 2 is where your long-term wealth grows. Higher volatility, higher return potential. Assets in this bucket can fall 20% or 30% in a given year. And that's acceptable because you have bucket 1 to live on. Contents: stock index funds, ETFs, real estate investment trusts, REITs, emerging market funds. In Canadian terms, XEQT or VEQT inside your TFSA, VDY for dividend income, VRE for Canadian REIT exposure. This is where compound interest does its heaviest lifting across your 30-year time horizon. Bucket 3, the dream bucket. Bucket 3 is the bucket most financial books ignore. Robbins calls it the juice, the part that makes the whole journey worth doing. When your risk/growth bucket hits a significant win, you move a defined portion of those profits into bucket 3. This is your strategic splurge. A trip to Japan, a kitchen renovation, a gift to your children, a charitable donation. Robbins is emphatic about bucket 3. Without it, the journey becomes joyless, and people abandon their plans. The dream bucket is not irresponsible. It is psychologically necessary. It rewards discipline with pleasure, on schedule with defined rules, so the rest of the system stays intact. Step 4. Define your 5 financial dreams. Step 4 asks you to define exactly what financial freedom means to you personally. Robbins identifies 5 levels. Financial security. Enough passive income to cover your basic needs. Housing, food, utilities, transportation, insurance. Financial vitality, security, plus some extra for small luxuries. Financial independence. Your investment income replaces your full current income. Financial freedom. Your investment income funds your ideal lifestyle. Absolute financial freedom. Anything you want, whenever you want, without ever thinking about cost. Most Canadians have never defined which level they're targeting, which means they have no specific portfolio number to build toward. Robbins' core insight: you cannot hit a target you haven't defined. Your action step: calculate the exact monthly passive income required for each of the 5 levels in your specific life. Then calculate the portfolio size required for each one. Financial security is likely much closer than you think. Here it is. The strategy that Tony Robbins calls the single most important investment insight in the entire book. The one that made him, in his own words, reframe everything he thought he knew about investing. It came from a single conversation with Ray Dalio, the founder of Bridgewater Associates, the world's largest hedge fund, managing over $150 billion. Robbins asked Dalio, if you couldn't leave your investment portfolio to your children, but could only leave them the principles behind it, what would those principles be? Dalio's answer became the all-weather portfolio. The problem it solves: every portfolio has seasons. Stocks do well during economic growth but crash during recessions. Bonds do well during deflation but get destroyed by inflation. Gold does well during inflation but badly during growth. Most portfolios are accidentally optimized for one or two economic seasons and devastated by the others. Dalio's insight: build a portfolio designed to do well, or at least not catastrophically, in every economic season. 4 seasons, 4 conditions: higher than expected inflation, commodities and gold thrive; lower than expected inflation, deflation, long-term bonds thrive; higher than expected economic growth, stocks thrive; lower than expected growth, recession, long-term bonds and gold provide protection. Dalio's original all-weather allocation: 30% stocks, S&P 500 index fund; 40% long-term government bonds; 15% intermediate government bonds; 7.5% gold; 7.5% commodities. When Robbins back-tested this portfolio from 1984 to 2013, it produced an average annual return of 9.72%, was positive in 86% of years, and had a maximum drawdown of just 3.93%. Compared to the S&P 500's maximum drawdown of 50% plus in 2008. In the 30 years tested, this portfolio lost money in only 4 years, and the average loss in those 4 years was just 1.9%. The Canadian adaptation of all-weather, the bond-heavy nature of the all-weather, is a meaningful consideration in 2026. With BOC rates at 2.25%, bond returns are modest compared to historical periods. For Canadian investors, the principles of all-weather are more important than the exact allocation. Hold assets across all 4 economic seasons. Use rebalancing to force systematic buy-low, sell-high discipline. Protect against both inflation and deflation, not just growth. A simplified Canadian all-weather approach: 40 to 50% in a broad equity EETF, XEQT/VEQT for growth seasons; 20 to 25% in a Canadian bond ETF, ZAG/XBB, for deflation protection; 10 to 15% in a REIT ETF, FHSA, for inflation protection; 10 to 15% in a dividend ETF, VDY, for income stability; 5 to 10% in gold or commodity exposure for additional inflation hedging. Step 5 is the mindset shift. Create a lifetime income plan, not just a savings plan. The goal is not to accumulate a large number. The goal is to generate reliable income that lasts longer than you do. Your action step: look at your current TFSA and RRSP portfolio. What economic season is it designed for? If it's 100% equities, it is perfectly designed for economic growth and poorly designed for recessions, deflation, or unexpected inflation. Adding bonds and real assets improves resilience across all seasons. Step 7 is the one that separates Money Master the Game from every other personal finance book ever written. After 600-plus pages of financial strategy, portfolio construction, billionaire interviews, and compounding mathematics, Robbins ends the book with the simplest instruction of all: just do it, enjoy it, and share it. Just do it means start now, not when you feel ready, not when the market is at the right level, not when you have more information. The greatest risk is not investing badly, it is not investing at all. Every year of delay costs you the compound interest that cannot be recovered. Robbins' most important message in this final step: the best time to start was 10 years ago. The second best time is today. Enjoy it means the journey itself is the reward, not the destination. Most people orient their entire financial plan around a future moment. When I have X dollars, then I'll be happy. Robbins argues that this framing guarantees unhappiness for the entire journey. The bucket 3 dream purchases, the milestones celebrated, the progress tracked. These are not indulgences. They are the system working as designed. Share it is the step most financial books omit entirely. Robbins draws from his interviews with the world's wealthiest people and finds a consistent pattern. The people who have genuinely achieved financial freedom and who report the highest life satisfaction are those who have built giving into the financial plan from the beginning. Not at the end when the pile is big enough. From the start. Robbins himself pledged to feed 50 million people when he wrote the book. He later extended that to 1 billion meals through his partnership with Feeding America. The psychological insight behind Step 7 is profound. Generosity is not a subtraction from wealth. For most of the billionaires Robbins interviewed, it is part of the identity that drives the wealth building in the first place. The Canadian application of Step 7, Canada has a uniquely powerful giving vehicle, the Donor Advised Fund, DAF. Contributing to a DAF generates an immediate charitable tax receipt, reducing your marginal tax, while the funds grow tax-free inside the DAF until distributed to registered charities of your choice. In 2025, it is estimated that Canadians donated approximately $19 billion annually to registered charities, but far fewer used tax-efficient giving structures to maximize the impact of those donations. The complete 7-step summary. Make the decision. Automate your Freedom Fund immediately. Become the insider. Eliminate fee drag. Understand the myths. Make the game winnable. Define your critical mass and timeline. Allocate to the 3 buckets. Security, risk/growth, dream. Create lifetime income. Design for all 4 economic seasons. Invest like the 0.001%. All-weather principles. Asymmetric risk. Just do it. Enjoy it. Share it. Start today. Celebrate milestones. Give with purpose. Your action step. Identify one giving commitment you can automate starting this month. Even $20 to a charity you believe in. Then automate your Freedom Fund contribution. Both on the same day. Both non-negotiable. Robbins' point is that the discipline required for one reinforces the discipline required for the other. Let's come back to where we started. 50 billionaires. 4 years. 688 pages. 4 universal principles. Don't lose money. Risk a little to make a lot. Anticipate and diversify. You're never done. Here's how the 7 steps deliver each one. Don't lose money. Step 2 eliminates the fee drag that silently destroys wealth. Step 4's security bucket ensures your foundation is never at risk. Step 6's all-weather portfolio is specifically designed to minimize catastrophic losses in any economic season. Risk a little to make a lot. Step 6's asymmetric risk principle. Every billionaire Robbins interviewed structures bets where the downside is defined and small, and the potential upside is large. Index ETFs do this by capturing the entire market's upside while limiting downside through diversification. Anticipate and diversify. Step 4's 3 buckets. Step 6's 4 economic seasons. A portfolio designed across all asset classes, all economic environments, all time horizons, is a portfolio that can withstand what cannot be predicted. You're never done. Step 7. The journey is permanent. The Freedom Fund never stops growing. The rebalancing never stops. The giving never stops. The learning never stops. Robbins' book synthesizes 50 brilliant financial minds into a framework any Canadian can apply with a TFSA, a low-cost ETF, and a monthly automated contribution. The critical mass for a median Canadian household on $93,000, spending $55,000 per year, is approximately $1.22 million. At 15% savings rate, 27 years. At 20%, 22 years. Tax-free. Inside a TFSA. Using the same principles that govern the world's largest hedge funds. The game is not as complex as the financial industry wants you to believe. The rules favor the patient, the disciplined, and the educated. You now have all three.